For decades, the backbone of economic success, whether in government, business, or personal finance, was built on long-term vision. Great companies rose to power not just by chasing quarterly earnings, but by investing in research, infrastructure, and human capital, sometimes at the cost of short-term gains. Governments, too, built highways, power grids, and public institutions that wouldn't pay off for decades, but ensured prosperity for generations. Yet today, we live in an era where long-term planning is actively undermined. The modern corporate landscape is dominated by executives rewarded for immediate shareholder returns rather than sustainable growth. The average lifespan of a Fortune 500 company has dropped from 60 years in the 1950s to less than 20 years today, largely because businesses no longer prioritize resilience. Instead of reinvesting profits into new technology, better infrastructure, or workforce training, companies spend billions on artificially inflating share prices to please investors in the short run, while leaving their foundations brittle in the long run. History has shown us that societies that abandon long-term thinking eventually pay the price. Yet despite the warnings, we are repeating the same mistakes. In the mid-20th century, the American corporate world operated under a fundamentally different set of incentives than what we see today. Executives, though paid handsomely, were still tethered to their companies in ways that encouraged long-term growth, stability, and sustainable expansion. The compensation gap between a CEO and the average worker, while significant, was nowhere near the chasm it has become in modern times. This period was characterized by executives who saw themselves as stewards of their companies, rather than transient operators looking to maximize short-term personal wealth. The structure of these businesses reinforced that mindset. Profits were largely reinvested, expanding operations, investing in research and development, acquiring competitors in ways that promoted long-term strategic growth, and raising wages to retain skilled labor. Companies remained on major stock indices for decades, and executives built careers spanning multiple decades within a single organization. Stability was a core value, and business strategy revolved around sustained profitability rather than immediate stock price manipulation. But in the late 20th century, a shift began. Shareholders, increasingly dissatisfied with what they perceived as sluggish returns, began to demand a system that more directly aligned executive performance with shareholder value. This led to an explosion in performance-based compensation structures, particularly those tied to stock prices. While this idea had merit in theory, encouraging executives to work in the best interest of the company's investors, it opened the door to an entirely new kind of corporate behavior, one that gradually eroded the foundation of long-term corporate strategy. The tipping point came in 1982, when regulations restricting stock buybacks were repealed. This single change transformed the stock market into a playground where companies could manipulate their own valuation with unprecedented ease. Suddenly, instead of distributing profits through dividends or reinvesting them into innovation, companies could simply buy back their own stock, artificially inflating share prices. This became an irresistible tool for executives whose compensation was increasingly tied to stock performance. At first, buybacks were framed as a strategic move, a way to return value to shareholders when a company believed its stock was undervalued. But that justification quickly faded. Executives realized that buybacks could be deployed regardless of company performance, creating the illusion of success even in the absence of true financial health. The practice became so widespread that over time, companies began prioritizing stock repurchases over all other uses of capital. Dividends shrank, R&D budgets were slashed, wages stagnated. This financial engineering, while lucrative for those at the top, introduced a troubling fragility into the economy. Companies that had once been pillars of long-term stability transformed into short-term profit machines, funneling resources into mechanisms that benefited executives and large shareholders at the expense of sustainable business practices. And it didn't stop there. As the culture of immediate stock price maximization took hold, many companies began borrowing money, not to invest in new projects or strengthen their workforce, but to fund even more stock buybacks. This debt-fueled cycle pushed corporate leverage to all-time highs, exposing companies to extraordinary risks should market conditions shift. It also dramatically altered the nature of corporate leadership. CEOs no longer needed to build companies that could endure for generations. Instead, they needed only to inflate stock prices long enough to cash out their bonuses and parachute out before the inevitable downturn. The days of the lifelong corporate executive were fading, replaced by a new breed of leader whose incentives revolved around extracting maximum personal wealth in the shortest possible time. As these practices took hold, the broader economy began to shift. The stock market, once a reflection of business performance, became increasingly detached from economic fundamentals. Valuations soared to levels that would have been unthinkable in earlier decades, fueled not by business expansion or productivity gains, but by financial manipulation. Price-to-earnings ratios stretched to extremes, signaling an economic environment where stock prices no longer reflected the true value of the companies they represented. Meanwhile, workers saw fewer benefits from their labor. While corporate profits climbed to historic highs, wages stagnated. The wealth generated by businesses no longer trickled down through higher salaries or expanded benefits. Instead, it was siphoned upward, concentrating economic gains among a small elite, while the average employee's purchasing power eroded. Even innovation suffered under this new regime. In the past, groundbreaking technologies and industry-shaping advancements often emerged from within major corporations, supported by robust R&D investments. But as companies prioritized stock buybacks over internal investment, many of these breakthroughs came instead from startups, businesses that, rather than growing into self-sustaining enterprises, were often acquired and absorbed by larger corporations, looking to eliminate competition rather than foster innovation. The consequences of this transformation extended beyond individual companies and into the broader economic structure. The rise of corporate debt, combined with an over-reliance on stock price manipulation, created an economic landscape that was more fragile than it appeared. On the surface, the market continued to rise, but beneath it, companies were increasingly vulnerable to economic shocks. And because so much of corporate wealth was tied up in inflated stock prices, any significant downturn risked triggering a cascade of financial instability. Yet, despite the clear warning signs, the system continued largely unchallenged because the very people who could have enacted reforms were the ones benefiting most from its continuation. Even as the risks mounted, there was little incentive to change course. After all, the consequences of short-term decision-making wouldn't be felt immediately. They would be a problem for the next quarter. Thus, the cycle reinforced itself. Executives who refused to play the game were replaced by those who would. Companies that prioritized long-term stability over stock price inflation found themselves outcompeted by those willing to engage in financial manipulation. The market rewarded short-term thinking, ensuring that it became the dominant mode of corporate governance. What had once been an economy driven by production, investment, and sustained growth had now become an economy of extraction. Value was no longer created, it was siphoned. The wealth of a company no longer reflected its productive capacity, but rather its ability to game the financial system. The incentives had been irreversibly altered, and in their wake, the very concept of long-term corporate planning had eroded. This shift marked a fundamental turning point in economic history, one where the pursuit of immediate gains overrode the principles of sustainable growth. Companies had once been institutions designed to endure for generations, serving employees, communities, and customers alike. They had become vehicles for wealth concentration, their primary function no longer to build, but to extract. And as this transformation solidified, it became increasingly clear that the foundations of the system itself were more fragile than they appeared. The question was no longer whether this model was sustainable. It was how long it could last before the inevitable cracks began to show. The cracks in the system are no longer just theoretical. They're everywhere. Boeing, once the gold standard of American aerospace, is now scrambling to fix decades of mismanagement. Instead of investing in engineering talent and safety improvements, it spent years prioritizing stock buybacks and executive bonuses. The result? Planes with safety issues, production delays, and a reputation in freefall. General Electric, a company that once symbolized American industrial power, followed a similar path, shifting focus from long-term innovation to financial engineering. It took on enormous debt to fund stock buybacks, gutted its core businesses, and ultimately collapsed under its own weight, breaking apart into smaller entities to stay afloat. The problem isn't limited to a few bad companies. The tech industry, once driven by groundbreaking innovation, is now dominated by firms like Meta and Google, whose biggest projects in recent years have been stock buybacks rather than major technological leaps. Intel, once the leader in semiconductor manufacturing, fell behind global competitors because it prioritized shareholder returns over keeping its factories competitive. Meanwhile, companies like Taiwan Semiconductor Manufacturing Company and Samsung surged ahead, investing billions into cutting-edge chip making. Now, the US is scrambling to rebuild an industry it once owned. Even finance, the sector that fueled this era of short-termism, is feeling the heat. The 2023 collapse of Silicon Valley Bank was a direct result of executives making risky short-term bets on low interest rates, only to be caught off guard when the economic environment shifted. Credit rating agencies, the same ones that failed to predict the 2008 financial crisis, are now issuing warnings about historically high corporate debt levels. Many businesses, having loaded up on cheap debt, now face a harsh reality as rising interest rates make their borrowing unsustainable. And it's not just corporations. Governments have embraced the same mindset. America's infrastructure, once the envy of the world, is now full of crumbling roads, outdated airports, and failing public transit systems, because funding long-term improvements doesn't win elections. For years, businesses and governments believed they could always find another shortcut, another loophole, another quick fix, but those options are running out. The companies that survive won't be the ones that squeezed every last dollar out of buybacks and debt. They'll be the ones that actually invested in their future. And as the consequences of decades of short-term thinking unfold, the world is about to get a harsh reminder that you can only ignore the future for so long before it catches up with you.